Hi, my name is Ken Lavisa. I have been a licensed CPA in Utah since 1983. Did you know that the IRS now has guidelines for calculating reasonable compensation from your S corporation? Gone are the days of taking none to little, saying $2,000 a month and calling it good. This loophole has been plugged. Please give me a few minutes of your time to explain how this works. When an S Corp distributes money to a shareholder-employee, the IRS requires that a reasonable amount be allocated to wages, also known as reasonable compensation. Since an S corporation is a pass-through entity, it made sense to keep wages low, which resulted in lower payroll taxes, FICA, Medicare, unemployment, etc. Since there was no definition of or guideline to determine what reasonable compensation was, this was easy to do. Not anymore. The IRS now has guidelines to determine reasonable compensation, and it is expected that they are shifting their audit focus from Schedule C filers to pass-through entities, S corporations and their shareholder-employees compensation in particular. So, when distributions are made to shareholder-employees, the IRS will allocate first dollars out to compensation until a reasonable amount test is satisfied. Amounts over and above that can then be called dividends. So what is considered reasonable? Reasonable is what one would expect to pay for like services in a like business under like circumstances, and it must be for services actually performed. Why? In order to avoid overcompensation, in order for shareholder-employees to make larger unjustified retirement contributions, for instance. There are essentially 9 factors in determining reasonable compensation. First 3 are obviously key. The more one has of these, the higher amount of compensation would be expected and considered reasonable. Certainly you would expect to be paid more, wouldn't you? An important point to note is that the IRS can only recharacterize the money taken out of the corporation. They can't force a shareholder to take any out. They can't force a corporation to distribute any. Again, the IRS will recharacterize first dollars out as wages up to the amount considered reasonable compensation, but only the money actually taken out. With that in mind, if you take a large dividend distribution but no to low wages, very likely you will be audited. Key ratios listed could also trigger an audit. So what should you expect? Expect more audits. There already have been more audits. So, how do you survive a reasonable compensation challenge? Got to be proactive. Research and document how you determined reasonable compensation. Have the board of directors approve it, then enter it into the corporate minutes. So if you're audited, you just show it to the examiner, and they will likely go away pretty quickly in pursuit of easier, lower-hanging fruit. The alternative is to establish reasonableness after the fact and negotiate with the examiner. This can be a time-consuming and expensive proposition, given that tax, penalties, and interest can easily be over double the original tax, plus the costs of professional representation and amending the returns. I have tools available to calculate and document reasonable compensation for you. It is critical to address this issue now as 2016 draws closer to its end. My contact information is on the next slide. Thank you for your attention.